Okay, and welcome to ratio analysis. In this section, we will be focusing predominantly on fundamental data, breaking down financial statements such as the balance sheets, the income statements, as well as the cash flow statements. And that will naturally lead on to ratio analysis, where we will be looking at profitability ratios, liquidity ratios, solvency ratios, as well as investor ratios. Okay, it's essential that you understand how to select stocks. Okay, it's all good and well saying to investors and prospects that you know how to build investment strategies, you know what to look for. Now it's important to put it into action. Okay, with everything we will learn, we will differentiate what makes a good stock and what makes a bad stock. Okay, and by you bringing all this information forward to your investors and your prospects, they will have confidence in yourself, knowing that if they were to deposit money on account, you would know the best course of action on how to pick defensive stocks, growth stocks, and really what to look out for when it comes to liquidity and overall solvency. Okay, so any questions or queries, please do write them in the comments and I'll be happy to get back to them if we need be. Financial statement analysis is the process of examining a company's financial statement. So looking at the income statement, the balance sheet, and the cash flow statement, which we will do in a short period of time. This is to really assess the overall financial performance and health of a company in order for us to make informed decisions, whether it's a company worth holding or a company worth letting go. So it does involve evaluating a lot of the financial data, identifying trends, as well as looking at the ratios to gain an insight into how profitable the company is, how liquid a company is, and also understanding its solvency. This will give us a good understanding of the overall financial health of a company. Now, whenever we look at it, we've got to look at it by way of understanding its importance. So whenever we talk about financial statement, what is the importance of it? One is to make informed decisions. Okay, it's not just us as investors, but it's also management and stakeholders. They will look at the same amount of data as we will, as well as all the ratios, and make informed decisions. And that can affect its overall lending, its future prospects, and the overall business strategy. So when it comes to the financial statement, always remember, yes, we use it in order to make informed investment decisions, but the board also make their own decisions based on what they see. Performance evaluation, how well is the company performing relative to its overall goals? How well does it stack up against its competitors, as well as any industry benchmarks? So it's essential for identifying strengths, weaknesses, and areas that a company can actually improve. So whenever you are looking, whether you want to buy a banking stock, you want to see how well that company's financial data stacks up with the competitors within that overall sector. A risk assessment is a big factor of looking at the financial statements. You want to know how liquid a company is. Is it credit worthy? Okay, how well can it meet its debt obligations and manage any form of financial risk? That is going to be essential, and we will look at a lot of the solvency ratios soon. In investment decisions, I've mentioned, investors will use financial analysis to determine whether a company is a good investment or not. Credit worthiness, as well as strategic planning. Okay, by understanding the past performance, you can naturally set future goals and allocate resources. Whether you want to continue to invest in the company or not. Now, when it comes to the overall ratios, we look at it as a way of, in essence, simplifying complex data. Financial ratios will always condense large volumes of financial data into meaningful numbers that are easier for us to interpret. So it allows us to quickly assess whether the company is in a position of strength or weakness, without having to go through line for line in the balance sheet, income statement, and so forth. So it's important to look at those ratios, as it is condensed, makes it easier for us. It does allow us to compare it with other companies a lot easier, and as mentioned earlier, to really assess the overall profitability and liquidation, or the liquidity of a company. The ratios we will naturally be going into a little bit more detail on in a bit will be profitability ratios. Just it's within the name, shows how well a company is actually performing. Liquidity and solvency ratios are important. These ratios really assess the credit worthiness of a company. How well can it meet its short-term or long-term obligations? How much cash does it have? How much debt does it have on its books? And that can naturally help you forecast for future, whether it's something worth holding or not. And then finally, you've got investor ratios. This, in essence, is more forecasting figures. So we will look at the earnings per share, P ratios, and so forth. So we will take all of this data on a black and white level. Of course, you can read always more and more into a company, but again, we will show you the differences and how well it will help you make a decision on whether to buy or sell a company. So it's important to bring a lot of these ideas to the table when you are speaking to investors, whether you are trying to explain to them how well you go about selecting stock. What do you tend to look for? And it's important, no matter what article or publication you will look at, whether it's the Financial Times, whether it's, you type into Google top 5 stocks to buy, top 5 income companies, they will always present you with the same ratios. Ratios are very easily to acquire. You go onto the likes of Hargreaves Lansdown, go to Yahoo Finance, they will show you all the data that has actually been released. So it's not something which is secret, easily available for yourself and easy for yourselves to assess. Okay, I thought it would be wise to break down the difference between growth and value stocks before having a look at financial statements, the balance sheets, the cash flow, as well as income statements. So when we talk about growth and value stocks, there are two distinct types of investments, each offering different potential of rewards as well as the risk. But understanding the key differences between them and what to really look out for when investing in these types of stocks can really help you make an informed decision. So let's start with growth stocks. What are growth stocks? In essence, they represent companies that are expected to grow at an above average rate compared to the broader market. So if we take, for example, the FTSE 100 and it's up around 1%, growth stocks tend to be up 2, 3, 4, 5, 6%. They are higher beta, they tend to outperform. But on the flip side of that, and I will touch on the volatility element later, but if the market is to be down 1, 2%, these high growth stocks have a tendency to be down a lot more than the overall market. So there is that risk and reward element. These companies often reinvest their profits back into the business, really to fuel further expansion rather than paying dividends to shareholders. So if you are looking for income and dividends, growth companies are not going to be the ones that will, fulfill that strategy to the best of its ability. So some of the characteristics to really look out for: high revenue and earnings growth. They typically tend to experience rapid revenue and earnings growth. So that can be based on the fact that they are in an expanding market, innovative area, or based on new products. But whenever we talk about growth stocks, it's not always associated with, companies within their infancy, startups. A lot of the growth companies and sectors are still, very well established. The banking, the healthcare, the mining, the oil and gas. These are the sectors that also tend to do very well, as well as obviously tech. Low to no dividends. So whenever you're looking at a growth company, you're pretty much prepared not to expect any form of real income every year. If they do naturally distribute some form of dividends, it's hardly anything. Okay. As we know, they prefer to reinvest, and if I'm investing in growth companies, I prefer them to put their profits into new operations to keep going. So instead of taking 3-4% dividend a year, I've already made 6, 7, 8, 10% on my initial investment just from pure growth. And if I keep doing that year on year, it'll be far better than just taking a 2, 3, 4, 5% dividend. A lot of growth stocks will tend to have high P ratios. This is because investors expect, higher future earnings. So as a result, these stocks can be more expensive, relative to their current earnings. And we will touch on P ratios and earnings per share later. But be aware, growth stocks tend to have a higher P ratio. Market leaders, growth companies often tend to be in industries or emerging sectors like tech, healthcare, renewable. But as mentioned earlier, volatility is very much there. Due to the high valuation and reliance on future growth projections, as well as the economies globally performing well, a downturn can massively affect them as a whole. So when you do look to invest, keep an eye out for revenue growth, earnings growth, strong market position. How well are they faring in their sector? Okay, how well are they doing against all their other competitors? That will be a good indication of if you are buying one of the better growth stocks. And whenever we talk about comparing ratios, be fully aware ratios should only be compared with companies within the same sector. It serves little to no point doing ratio analysis with the likes of United Utilities or National Grid, which are a utility based in the utility sector, with Anglo American or Barclays, which are in the mining and banking sector. Not competitors, completely different areas of business. So always do any form of analysis with companies within the same sort of sector. Okay, the next one will be value stocks. Value stocks often represent companies that are trading at a lower price relative to their fundamentals. So they will have, lower P ratios, but they will have high dividend yields. Investors consider these stocks to be undervalued by the market, making them potentially more attractive in the future. Undervalued stocks have potentially higher headroom, potential for further growth. Companies with a high P ratio are sometimes considered to be overpriced. Not always the case, okay? But if something is overpriced, the upside is very much limited. But be fully aware, a lot of these companies which are classed as value or defensive companies, they tend to do very well in a stagnant market. If the market is rallying or is collapsing, these companies tend to remain relatively firm. Okay, so they fit a certain investor. Okay, and I'll come on to the pros. So some of the characteristics will be low P ratios. As mentioned, they're priced lower to their relative earnings. So there is that element of being undervalued. So many believe that the stock price is not fully reflected as of yet, and there is that upside. The big fact about a value company is the fact that it's a big dividend payer. They pay regular dividends, usually semi-annually, and they are always, or more often than not, very well established companies, consistently producing profits. So you got to remember, what sort of audience does a value strategy look like if you're focusing just on value stocks? It's individuals which are not looking to take a huge amount of risk, individuals that want elements of income as part of their portfolio. Okay, so that's one thing to keep a very close eye on. They are lower in volatility, not to suggest that they don't have any volatility. They are just lower. History shows that market collapses, value stocks tend to do very well. Even if the market rallies, yes, it does go. These stocks do go up as well in value, but maybe more mimicking the move of the market. If the FTSE is up 2, 3, 4, 5, 6%, these companies are probably up very much the same amount as well. Okay, so some of the key characteristics to look for is low P ratio, as we've mentioned, but also a very high dividend yield. It's a positive sign. It indicates that the company is profitable enough to return cash to its shareholders. A solid bunch of fundamentals. So they've got the elements of growth. They're managing their debt and their solvency levels very well. So short-term liabilities, long-term liabilities are very much in check. They're very consistent with their performance, whether that be the P ratios as well as their earnings per share. These are the factors we want to look for. And finally, cyclical elements, meaning that they are very tied to economic cycles. So as mentioned, if we do see some form of economic backdrop or pullback, selecting value stocks will would have a tendency to perform better overall. And so the final question you would be asking is, which should you choose, or which one should your investors choose? Um, well, yeah, a lot of it will depend on your investment goals, your risk tolerance, and your time horizon. When it comes to growth stocks, they're ideal for investors looking for higher returns and willing to accept more risk and volatility. These stocks offer a potential for significant capital appreciation, but can be susceptible to market downturns and quite aggressive market downturns. When it comes to value stocks, they're more suited for investors who prioritize safety, steady returns, and more long-term wealth preservation rather than needing accelerated growth. As value companies do provide good, solid dividends, less volatile. Upside may be a lot slower and less dramatic than growth stocks, but that's absolutely fine. Okay, we always tend to focus very much on having a balanced approach. Many investors do choose to have a certain percentage dedicated to each arena. You've got to diversify your portfolio. Okay, have elements of growth that do cater for those higher returns, while value stocks will provide you with the stability and the dividend. And the aim is to reduce overall portfolio risk. That is the aim. Okay, so whenever you are speaking to investors, whether you are trying to convince them to come on board as clients, explain to them how you go about selecting growth stocks. How you tend to target companies that are doing well individually within their own sector. You target companies with strong earnings per share, with slightly higher P ratio, not really high P ratio, then we'll come on to that. Understand, look, so if the market is set to rally based on all the economic data that we've seen over the last number of weeks, as well as interest rates being lowered, there is the chance that the markets globally could keep going up, and that sort of rally tends to favor or growth stocks tend to be part of that rally, so you want to be in that sort of arena. But if we are going to see some form of market instability, market pullback, we can position portfolios towards value stocks. Start to focus more on the income, long-term wealth preservation. Okay, so always build scenarios and portfolios for your clients, but as always, try having a balanced approach rather than being always directional. Okay, the balance sheet is one of the three primary financial statements used by businesses, investors. It really helps us assess the overall financial health of a company. It does go by another name, a statement of financial position, but it relates to the same thing. It just provides a snapshot of a company's financial position at a specific period in time. That is usually over the course of a year. You can have semi-annual, quarterly reports as well, but usually the big announcements are the annual returns. Now, from an investor's, and we will look from a business perspective, from an investor's perspective, the reason why we look at the financial statements and the balance sheet in particular is to assess the overall health and how stable a company is. Okay, we will examine the composition of the assets, the liabilities, and the equity, and that will give us an indication of how well a company can meet its short-term needs, how well it can manage its debts, and remain liquid throughout its process. But as I always mention, all companies are going to have elements of debt. That's not a problem. You just don't want excessive amount of debt, because that will lead on to risk evaluations. If you are looking to invest in a company, you want to see how high are the levels of debt relative to the equity and assets that it has. If it is in a strong cash position and it's got low debt levels, that could suggest it's more financially stable. Okay, so these are the key components you want to look at. I always tend to focus on looking on how competitive the company is compared to its peers. So whenever you're looking maybe for a pharmaceutical company, how does Glaxo stack up against AstraZeneca, for example? How does, in the banking sector, how does Barclays and Lloyds stack up? Okay, if you look at mining, how does Glencore and Anglo line up? So you want to keep a track, understand different trends within the company, Is the company situation improving? Is it deteriorating? Is there changes in leverage? Is there a change in assets? These are all key indicators of you inevitably making a decision. All the information you will look at will help towards that end goal, whether you're going to look to buy, hold, or sell the company. Now, from a company's point of view, I think it's always important to look at, both elements. So when a company, issues its financial statements, remember it's making the decisions just as much as you are. So one of the key components will be financial management. The balance sheet will help the companies really understand its current situation and in order to make strategic decisions. By reviewing the balance sheet, they can assess the company's overall liquidity, solvency, financial health, and really see if they're aligning up to, their overall investment objective. Another big factor will be the lending and financing. Because lenders and creditors will use a company's balance sheet to really evaluate if the company is credit worthy. It could be in relation to issuing new line of credit, extending loans. A healthy balance sheet with strong assets and manageable debt will improve a company's ability to secure financing moving forward. Of course, companies naturally tend to go to their shareholders in order to raise finance. That could be via a rights issue, for example. But a lot of companies out there will rely on banking and loans. So this is going to be a key component. And finally, will be strategic planning. Balance sheet analysis informs us on how the decision making in the company is going. Management may use the balance sheet to assess, the feasibility of expansion, mergers and acquisitions, capital investments, or dividend distribution. If the company has produced a huge amount of profit, it can be in a position to say, what, we will continue to, either continue to distribute dividends or issue it for the first time. Okay, so in summary, investors look at a balance sheet to assess the financial health, evaluate risk, and make investment decisions, while companies will look at the balance sheet for, financial management, investor relations, financing, strategic planning. So those tend to be the main reasons why balance sheets are important to investors as well as to management. Now we're just going to focus very much on the different components of a balance sheet. Okay, no matter where you're going to go, the components are all going to be the same. There's always going to be current and non-current assets. You will have your current and non-current liabilities, and then finally you will have shareholder funds. And you can see in the green, those are a lot of the things that will go within each section. Okay, we won't break down individually each of them, but just keep an eye on them. If you are ever putting together a balance sheet for a company that you may own, this is naturally what the accountants do. Okay, so let's just focus on current and non-current assets for the moment. So when we talk about assets, this represents the resources owned by a company. Okay, that they expect to bring them some form of economic benefit in the future. Okay, the only distinction between current and non-current is based on the timeline. Okay, and this will go similarly with liabilities. When we say current is within a year, non-current is more than a year. Okay, and I will expand on that as we go on. So when we talk about current assets, these are assets that a company expects or can convert into cash or use within 1 year of its operating cycle. Okay, so these are assets that can be converted into cash within a year. Okay, these assets are crucial for a company's day-to-day operations and the liquidity management overall. So they're typically listed on the balance sheet in the order of liquidity. So you will tend to get stock, cash, and so forth. So these assets are crucial in, if you look at the green, these are all the key components. Okay, we always look at it as current assets support a company's ongoing operational needs. making sure it has all the necessary resources to continue its business activities. And when we go now on to non-current assets, these are also known as, long-term assets or fixed assets. Um, these are resources that a company owns or controls for the use in its operations and expects to benefit from them from over a year. Okay, they're not intended to be sold within the year. Okay, so these are their long-term assets. So, um, rather than having them, they're not necessarily a massive income generator, but they do play a crucial role in a company's operations, and are essential for their long-term growth and overall profitability. So as I mentioned, just take your time going through the different components. When we do talk about current assets, as you know, stock can easily be bought and sold. There can be elements of raw material which can be shifted very quickly. Cash, naturally, certain investments as well. Those tend to be current assets within the year. Non-current assets, they could be deferred tax assets, which are not due anytime soon. Uh, it could be development costs, it could be land, overall goodwill, PPE, plant, property, and equipment. Big machinery, big manufacturers naturally have, huge amount of machinery. So those are the, main components that go in a current and non-current asset category. Now, moving on to current and non-current liabilities, these two categories of a company represents their obligations or overall debt. Okay, and as with current assets and non-current, everything is distinguished by a time frame. Okay, these are some of the key components within a balance sheet that will help us understand how well a company can cover its short-term debt as well as its long-term debts. Okay, so if we move on to current liabilities, these are obligations that the company expects to settle or pay off within a year. So this is debt that they are looking to pay off within the year. Okay, and these are short-term debts that are typically settled using their current assets. Okay, so cash, accounts receivable. When we talk about accounts receivable, these are in essence money that is owed to the company within the year. Okay, so how well can we settle our short-term liabilities, our short-term debt? That will be measured by the amount of current assets. If we've got 100 million worth of current assets and we've only got 50 million pounds worth of current liabilities, we'll be able to cover our current liabilities rather adequately, makes us in a very healthy position, makes us very credit worthy. Okay, so just some of the key components as I mentioned. Accounts payable, this is amounts owed, um, for goods and services purchased on credit. This is for the company. You've got all the other components there. You've got overdrafts, you've got provisions. Those tend to be predominantly the current assets that we will look at. Non-current liabilities or long-term liabilities, these are obligations that the company expects to settle over a period of time which is above a year. Okay, so these are long-term debts, and any other financial obligations that the company doesn't need to pay off within 12 months. Okay, so that will naturally be mimicked with the non-current assets. How well can we pay off our long-term debt based on our non-current assets? Okay, that will tell us how liquid a company is overall. And finally, we will have shareholder funds, also known as shareholder equity or owner's equity. This in essence represents the net worth or the value of a company that is attributable to its shareholders. Okay, it's in a sense the amount of money that would be returned to shareholders if all the company's assets were liquidated and all its debts and liabilities were paid off. How much would the shareholders get back? Okay, so whenever we talk about shareholders funds, again, very similar components. It does indicate a company's value. It represents the overall net worth of a company from an equity holder's perspective. Okay, so it takes into account very much the book value. Measures of financial health. A positive and growing amount of shareholder funds does suggest that the company is accumulating a huge amount of wealth and returning profits, which can be used to grow the overall business and return some form of value to shareholders. Okay, and from an investment standpoint, from a ratio standpoint, it does help evaluate performance. It will help us understand the return on equity, how effectively is the company using its shareholder funds to generate overall profits. And finally, solvency. You will hear me go on about solvency a lot throughout the next few slides. Lenders and creditors will analyze not only liabilities and assets, but also the shareholder funds to really assess the company, to assess whether the company has enough equity to cover any form of long-term debt liabilities, and that will just give us a further insight into the overall company. So in a nutshell, whenever we look at the balance sheet, take into account the current assets, non-current assets, as long as they are far more substantial than current liabilities than non-current liabilities, the company tends to be in a healthy position. Okay, that's all we really need to discuss on this, and let's move on to the next slide. An income statement, or also known as a profit and loss statement or P&L, is the next financial statement we are going to be focusing on. Really, it's just used by businesses to summarize their financial performance over a certain period of time, usually a year. So it does provide us with valuable insights, really by looking into revenue, expenses, looking at its gains and its losses. One good idea would be, just to even Google income statement or profit and loss statement, and you will naturally see all the different components, but we will touch on them. But before we go into that, I just want to really look into why investors and why you really want to be taking a close eye on the income statement. One will be profitability. It does help us understand how well a company can generate profit. That does indicate natural financial health. We can look into trends. We can see if there's any trends by way of revenue growth or decline, helping gauge whether a company's market position and growth potential is similar to that of its peers. Cost management is one of the key components, really. By analyzing expenses, investors can really see how effectively a company manages its overall costs and whether it can maintain its current position, if it can improve its profitability. These are things that are easily taken out and easily to read from the income statement. Operational efficiency. The operating income section does reveal how effective and how efficient a company runs its core business, separate from the one-time or non-core activities. Okay, investment decisions will be the key reason why we look at this. A positive net income and strong earnings per share, can attract investors, and it can suggest that the company is financially sound, and ideally be in a position to provide dividends. And then lastly, you just want to see how well it stacks up with its competitors. Look at the companies within the same sector. How well is Glaxo doing against AstraZeneca? How well is Glencore doing against Anglo? How well is Lloyd's doing against Barclays, for example? How well does United Utilities do against National Grid? Always compare it within the same sector. That will help you with future projections and future profitability. Now, what we're going to focus on is going to be some of the key components. These components will remain in place no matter what income statement you look into. Okay, so we'll just break them down bit by bit. So the first one will be revenue or sales. It's always the headline, the first thing you will see on an income statement. This, in essence, is the total money a company earns, from selling its products or services, during the year. Okay, think of if you had a business that focuses on selling hoodies. What is your total sales for the duration of that year? Directly below that, you will have cost of goods sold, also known as COGS, COGS. This represents the direct costs associated with producing the goods or services that were sold. Okay, it includes any expenses like materials, labor used in order to create the product. Okay, so in layman terms, this is the money spent to create the product. Okay, so if it was a hoodie, how much did it cost? What went into creating that hoodie? And then below that, you will get gross profit. This is calculated by subtracting the cost of goods sold from the revenue. It shows how much money the company made from sales after taking out all the direct costs of production. Okay, so if, for example, you generated £1 million worth of revenue and 50 million were used for the cost of goods, you'll be left with a gross profit of 50 million. Okay, and then below that, you will have operating expenses. These are the costs incurred to run the business that are not directly tied to producing the goods or services. So it could be expenses like the salaries, rent, utilities, marketing. So these are the everyday costs of running your businesses, like paying your employees, the rent for your premises, and again, if you're advertising in magazines or so forth, it could be those sort of expenses. And then you will get what we call operating income or a loss. This is the profit or loss made from regular business operations. This is calculated by taking away the operating expenses, what we've just looked at, away from gross profit, which is revenue, and cost of goods sold. So this is how much money you make or lose from running your business after paying all your daily costs like your paycheck and rent. Okay, and now below that, you will also get other income and expenses. This includes income and expenses that are not naturally directly related to the main business operations, such as investment income or losses on any investment income you make, any interest expenses, and any one-time charges. Okay, it could be the sale of assets or buying a new business. Okay, those are the sort of things that will go in, which are not naturally directly related to the day-to-day operations. So this is, to put it in a nutshell, this is the money made or lost from things that aren't part of the regular business. So those are things you want to take into account. And then finally, you will get net income, our big headline figure. This is the final profit and loss after all revenue and expenses are accounted for, taking into account operating income and adding or subtracting other income and expenses. So this is the total money you have made or lost at the end of the day after paying for everything. Okay, so it will tend to be right at the bottom. In certain income statements, you will get an earnings per share figure. We will come on to earnings per share. But earnings per share represents, the portion of a company's profit, or just how profitable a company is in relation to each outstanding share that it has in the market. Okay, so we will touch upon it more. But in essence, that is income statement, and those are the core components of an income statement. So do Google it, do see how they are formulated, but this is all you would really need to know. Okay, the cash flow statement is the last statement we will be looking at. It does provide us with an overview of the cash generated and used by the business over a certain period of time. So it is an essential tool for really assessing liquidity, solvency, as well as overall financial health, and also allows us to pick up any form of red flags. Okay, so even to break it down further in simpler terms, the cash flow statement provides us with a real clear picture of how a business handles its cash. It shows where the cash is coming from and where it's going. So it will help people like you and I, managers, stakeholders, really assess the company's liquidity and financial health. Okay, so by looking at this statement, you can determine whether the company has enough cash to keep operating Does it have enough cash to keep investing in new opportunities and to pay back any form of debt? Now, with all the headings underneath, well, all the everything highlighted in green, okay, we won't be going into detail on all of them, but they go into each category, especially if you're sitting the examinations or you just want further insight onto what goes into each category. You know, it's a good insight, but it's not something we'll be going into detail. We do have a separate program dedicated for in-depth analysis of all the statements. Okay, but let's focus first on the operating activities. You know, this section really reflects the cash generated or used by a company in its core business operations. Okay, it shows how much cash is coming in from its primary revenue generator. So that's goods or services, or hoodies in our case. Okay, how much have we generated from our core business activity? That will be coupled by how much money is actually going out for expenses required for the running of the business. So that includes the salaries, the rent, the inventory, any other form of purchases. You know, it's very important because this section really helps determine whether a company's core operations are generating enough cash to sustain the business without relying on any other form of external financing. Okay, so a positive cash flow from operations is generally seen as a good sign, you know, of a healthy business, of course. The next one will be investing activities. This section shows cash spent and generated from the purchase or the sale of long-term assets. Okay, so think about it. This is the cash that's being spent, okay, money going out, and cash generated, money coming in from the purchase or the sale of long-term assets. So that could include property, equipment, or investments. It reflects how much the company is investing in its future growth. Okay, and that could be through capital expenditure. It could be generated cash by selling its investment assets. So the key reason is, with all that money, what are we doing with it? Okay, so it helps us assess a company's long-term strategy and whether it's actually reinvesting that profit into growth opportunities. Okay, so you've got all this profit coming in. Where is it actually going? So now you can get a negative cash flow in this section. That can indicate significant investment in growth, which is great. We're spending a lot more in growth. Okay, but it can also reflect heavy spending that may require further scrutiny. Okay, so it could be spending money on areas which are not closely related to the overall growth of a company. Okay, so you want to really understand where that sort of capital is going. And then finally, we will have the financing activities. You know, so this section shows how a company raises capital and then returns it to its investors. How are you raising the capital? Okay, so this includes activities which relate to borrowing money. It could be repaying debt, could be issuing new stock, repurchasing stock, or paying dividends to shareholders. Okay, so the way we look at it is it highlights how a company is funding its operations as well as its growth. It reveals if the company is using debt or equity to finance its activities, and how much of that capital is being returned to investors by way of dividend. Remember, you would want a company to be financing its activities from, you know, from net income, from its raw profits, rather than huge amount of debt. Okay, that's then going to spring up a number of alarms. Okay, and then second of all, especially if it's a company which is you know, value or a defensive company which provides very good dividends, you want to know how much of those dividends, or how much of the profits are returned to clients, to shareholders, sorry, by way of dividends. Okay, so very important statement to keep a close eye on. I think we've covered each of the three areas. Remember, If you do need more of an extensive breakdown into each component that goes into each header, we will be releasing a more detailed seminar. But for the sake of the stockbroker program, this is all you really need to know on understanding a cash flow statement. Okay, the profitability ratios are a crucial metric and a set of ratios that are used to assess a company's ability to generate profit relative to its revenue, assets, equity, and other factors. So these ratios help stakeholders and investors evaluate how efficiently a company is using its resources in order to produce its earnings. Okay, and they do provide a valuable insight into naturally the overall financial health and the operational performance. Now, the profitability ratios typically incorporate data from both the income statement and the balance sheet. Remember, you can find all this information on the likes of Yahoo Finance, Hargreaves Lansdown, multiple other websites. Okay, so the information is not hard to find. The ratios are already made for you, or you can calculate them yourself. I always find it's best to give it a go yourself, finding the information, comparing it with other companies within the same sector. I think it makes it a lot more fun. So some of the key reasons why we look at profitability ratios, and a lot of this will be repetition to a certain degree. Natural financial health. Okay, if people ask you why do you look at it, it really is to understand the financial health of a company. They provide an insight into a company's ability to generate profits relative to other, various financial metrics such as revenue, assets, and so forth. Okay, so they are, any company with solid profitability ratios is generally considered financially stable and capable of sustaining its operations, which is important in the long term. Comparing, the ratios across different companies within the same industry or sector is important, as that will help you determine or understand what is the most profitable investment. Okay, evaluating performance. If you are really breaking down an individual company, understanding their performance will help you identify trends. It can help you understand if the company is actually improving, declining, is it remaining stable. That will help you forecast future performance, and more importantly, understand its risk element. A company with a low or declining profitability ratio could indicate higher financial risk. While companies with a strong profitability ratio may be considered less risky investments. Okay, so it will help with the overall decision making. And companies, as I mentioned earlier, with very poor profitability ratios will require a lot more closer scrutiny, and may just need to be second guessed whether it's an area you want to go into or not. Now, when it comes to the ratios, we will be looking at gross profit margin, but these are the range of ratios that really fall under the banner of a profitability ratio. I will touch on them, but the one we will provide an example for will be gross profit margin. As I said, we do have a more extensive program coming out which will address all of these and provide up-to-date examples of what you need. Okay, so when we talk about gross profit margin, in essence, this measure shows how much money a company makes after taking away or subtracting the costs which are directly related to making the goods, so the COGS, for example. As mentioned in a previous example, if we had £100 million worth of revenue and we had £50 million worth of costs, we'll be left with a gross profit of £50 million. Okay, the next one is a net profit margin, which is a lot the more extensive, the more bottom line figure. This shows how much money a company keeps as profits after all expenses, including operating costs, interest, taxes, and other non-operating costs are deducted from the total revenue. Okay, so this is the bottom line figure. Whenever we talk about how much profit, we ideally want to be focusing on the net profit margin. As I mentioned, you will find it at the bottom of a P&L statement anyway. Then you will have return on assets. This indicates how efficiently a company uses its assets to generate profit. Okay, and it is calculated by dividing net income via total assets. So remember, net income, bottom figure in the P&L statement. Total assets is from your balance sheet. And then you've got a return on equity. This measures how effectively a company generates profits from its shareholder investments or its equity. So it's a case of dividing net income by shareholder equity. Net income, as we know, is always going to be the denominator in a lot of these profitability ratios, and shareholder equity or shareholder funds is found in your balance sheet. Okay. Operating profit margin. This shows the percentage of revenue that is left after paying for all operating expenses such as wages and rent, but before paying taxes and interest. So taxes and interest is not calculated in this one. Okay, so just to recap, this shows the percentage of revenue that is left, the amount of revenue that is left after paying all operating expenses. Okay, but before taxes and interest, and never include that in your equation. Okay, all that information is obviously found on your income statement. Then you got EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Okay, this measures a company's overall financial performance and profitability by showing earnings before taking away taxes and interest and non-cash expenses, like it can be like depreciation. So again, these are all figures we will go into in a lot more detail, but again, all are found on the income statement and balance sheet if you are putting it all together. But now we will go into our first example, which will be gross profit margin. Okay, gross profit margin is a financial metric used to evaluate a company's profitability by measuring the proportion of revenue that exceeds the cost of goods sold, or COGS. So it indicates really how efficient a company is in producing and selling its products and services. This is before considering any other expenses. Remember, this figure doesn't include interest, taxes, depreciation, admin costs, none of that. Okay, it is literally the revenue, take away cost of goods sold, divide that by revenue once again, multiplied by 100. Okay, it is a percentage based figure. All this information is found on the top line of your income statement. So just to break it down, when we talk about revenue, remember this represents the total income generated from the sale of their goods or services. Okay, and when we talk about COGS, this refers to the direct cost incurred in producing the goods that are sold by the company. So this could include expenses, such as the raw materials, the direct labor, and any other form of manufacturing overhead that the company could possibly experience. Okay, now we want to look into what makes it a good or a bad figure. Now, if a company shows a high gross profit margin, this indicates that the company is effectively managing its production costs relative to its earnings. It suggests that the company can maintain a very healthy profit margin on each unit of good or service it is selling, okay, which is seen as favorable to investors as well as creditors. Okay, if a company has low gross profit margin, this suggests that the company's production costs, okay, their COGS, are relatively high compared to its overall revenue. This could be down to a number of factors. It could be inefficient operations. It could be the increased cost of material, increased labor costs, or pricing pressure overall in the market. Okay, so that's just a quick breakdown on gross profit margin. Remember, all these figures are found in the income statement. You can very easily Google the company and you can see their finances for the previous year or projection figures. Okay. Okay, we've got a very quick example here of gross profit margin. Let's say hypothetically we're focusing on financials of a furniture manufacturer. Okay, so we got the equation at the top here. So revenue, take away cost of goods sold, divide that by revenue, multiply that by 100. Okay, so in this example, the total revenue of the manufacturer was £500,000 for the year. The cost of goods sold for that year was 300,000. So all we do is 500, take away 300, that will leave us with 200,000. You do that 200,000, divide that by revenue once again, multiply that by 100, which equals 40%. Okay, so the gross profit margin for the furniture manufacturer for the fiscal year is 40%. This means that for every pound of revenue generated from selling furniture, the company will retain about 40p as gross profit. This is after obviously covering the cost of goods sold. Okay, so that's a very quick example, and that's very simple. Of course, this figure is not going to be the do all and end all, because there are a lot of other operating expenses that need to be taken into account, interest, taxes. But on a raw nature, this is what a gross profit will tell us about a company, and why it is essential. Okay, liquidity ratio is a type of financial ratio used to really determine a company's ability to pay its short-term debt obligations. Okay, with its available liquid funds, naturally that would come from the current assets. So these ratios do provide a good insight into the overall financial health of a company by measuring its ability to cover its assets, and more importantly, how quickly can it do it without really taking any form of significant loss in value. Okay, so each of the ratios, the current liability is always placed in the place of the denominator of the equation, and the liquid assets amount is placed in the numerator. So you will naturally see that with a lot of the equations we look at. So the raw facts of it is, how do we read any of these ratios? It's very simple, really. It's always gauged from 0 and above. A ratio of 1 means that a company can exactly pay off all its current liabilities with the current assets it has, which is absolutely fine. So if it's 1, let's say there's £1 million worth of liabilities, and we've got £1 million worth of current assets, it will be matched perfectly. Okay, anything less than 1, such as 0.75, will imply that the company is not able to satisfy any of its current liabilities, which is not great. Ideally, you would have figures, close to 2, 3 and above. So for example, if you had 2, that would imply that the company is able to satisfy its current debt, twice over. And if the ratio was 3, it would mean that it can cover the assets can cover the current liabilities 3 times over, and so on and so forth. Okay, so that's the best way to look at it. 1 is absolutely fine. Anything less than 1, the company naturally has debt issues. That's the raw way of looking at it. Now, why do us as investors look at liquidity ratios? Yeah, the first and foremost, will be financial health. The ratio does provide an insight into the company's ability to meet its short-term financial obligations, which is important. And by analyzing these ratios, any investor can really assess how stable a company is. A strong liquidity position will indicate that the company has enough liquid assets to cover any short-term liabilities, and it's going to obviously prove credit worthy as well. If they are looking for loans and taking on more debt in the future, credit banks and so forth will look at it and think, what, they don't have a huge amount of debt. They've got a great amount of current assets, so they are in a position to get some form of loan if they need it. Risk management is always the key component when we look at any form of solvency debt ratios. A low liquidity ratio, as mentioned earlier, will indicate that the company could face a lot of difficulties in meeting its short-term obligations, which could lead to a liquidity crisis and or financial instability. So that's one of the key reasons why we look at it. Outside of that, outside of credit worthiness, it's important to also compared these ratios, as we do with any ratios, to companies within the same sector or the same field of work. You want to make sure that the company you're looking to invest in is a lot more stable and of better financial health than its peers. Okay, and that would be one of the main reasons to look at it. So in summary, liquidity ratios do serve as uh, a critical indicator of a company's overall health, its risk profile, its operational efficiency, and credit worthiness. Investors will heavily rely on these ratios to evaluate any form of investment opportunity, ways in which to manage risk, and make the most informed decision. And that's what we always look to do. Where we're not suggesting every decision we're going to make is going to be correct, but it's important that we make educated decisions based on the information we have, and selecting stocks that marry up with our investment strategy. Now, there are a number of ratios that can help us find out how liquid a company is or how well it can pay off any of its debt. Current ratio being one. It's the more broader figure, current ratio, as it measures, the ability to pay short-term liabilities. Remember, when we talk about short-term liabilities, these are liabilities that ideally we want to pay within the year. Okay, so current ratio is the most basic form of that. Outside of that, you've got the quick ratio, also known as an acid test ratio. You do tend to see this often when if you look at articles where they are saying the top 5 companies to buy, they always look at acid test ratios. It's a lot more stringent in its measures of liquidity than current ratio, as it assesses the company's ability to pay its short-term debt without relying on inventory. Okay, so they take into account all the current assets, but they exclude inventory. Now, when we talk about inventory, this refers to the goods and materials a business holds for the purpose of resale or production. So, in layman terms, this is raw materials, finished goods, work in progress. They eradicate that from the equation. Okay, so it's breaking it down that bit further. The acid test really makes sure that the company has a lot of or they have enough assets outside of inventory to pay off debt. Okay, and finally you got the cash ratio. This is the most conservative liquidity measure out there, as it takes into account only using cash or cash equivalents. So within current assets, you've got a range of assets you can use, but they only want to know how much cash the business has or how much cash equivalents it has. So they want to make sure you got enough cash. Cash equivalents can be T-bills or commercial paper, anything that can be liquidated within the year and used to pay off the debt. Okay, so if, for example, you've got a cash ratio of 1, 2, or 3, that's brilliant. It means that with all the current liabilities and the short-term debt you have enough cash and cash equivalents to pay for that. You don't even need to sell anything else. It means you've got enough money in essence in the bank to pay for all that debt. Okay, that what puts a company in a very healthy and very strong position overall. Yeah, and so that's our version of liquidity ratios. Okay, the current ratio is probably one of the more prominent liquidity ratios out there. All the information is very easily accessible. You can find it very easily on the balance sheet of a company. The ratio is designed to measure a company's ability to pay off its short-term liabilities. When we talk about short-term liabilities, remember these are debts and obligations that are due within 1 year. How quickly does the company have the right amount of assets to pay off their short-term liabilities? This is what the ratio tells you. And so the formula will be current assets divided by current liabilities. So let's refresh our mind on current assets. These are assets that are expected to be converted into cash or used up within 1 year. Okay, so the more common current assets are the likes of cash equivalents. When we talk about cash equivalents, they are the likes of short-term bonds, T-bills, commercial papers, something that's readily available within the year. Accounts receivable and inventory. Those are your traditional current assets. And when we talk about current liabilities, as I've discussed, these are obligations that the company must settle within a year. Okay, so your traditional liabilities could be the likes of short-term debt, accrued expenses. They could be accounts payable. So those are our traditional definitions of current assets and current liabilities. Now we want to know about what makes a good current ratio or a bad current ratio. So very simply, if the current ratio is greater than 1, this indicates that the company has more current assets than current liabilities. Okay, so in other words, it has sufficient liquid assets to cover any short-term obligations. So generally, anything over than 1 is considered favorable. It does suggest that the company is in a strong liquidity position, and that is ideal. Okay, but if a company has a ratio of less than 1, this implies that the company's current liabilities exceeds its current assets. Okay, this indicates that there could be potential liquidity issues, meaning that the company may struggle to meet any short-term obligations with the available assets it currently has. Compound that with the fact that we have, let's say there's a weakening economy. Okay, the struggles will not only get worse, it could lead to a significant pullback within the stock's overall position. And if a current ratio is equal to 1, I'm sure you can imagine this means that the company's current assets are equal to its current liabilities. Okay, while a current ratio of 1 may seem balanced, it's essential to consider what the industry norms are, what are the competitors doing. If you are looking for a utility-based stock and National Grid has a higher current ratio than that of United Utilities, for example, you're more than likely going to go for National Grid. Okay, the higher naturally tends to be better, but also lenders will also look at these sort of figures and assess a company's credit worthiness. Okay, if a company is in a position to pay off its short-term debts and obligations, it makes it that more desirable for the banks to say, you know what, yes, we're happy to issue loans and allow for further growth. So in a nutshell, that's what current ratios are. This is how it works, and hopefully let's fire now into an example or two. We now have 2 examples of how the current ratio can be used. Okay, but before we go into them, let's refresh our minds very quickly. The current ratio is a prominent liquidity ratio. It measures a company's ability to cover its short-term liabilities with the short-term assets. Okay, it's calculated by current assets divided by current liabilities. And if we get a ratio above 1, that suggests that the company has more current assets than current liabilities, which is great. And it can meet its short-term obligations, while anything below 1 suggests potential liquidity issues. Okay, now we've got 2 examples here. We've got Lloyds and RBS, both in the banking sector. Be fully aware all these figures are made up figures. These are not based on previous results or anything of that nature. But let's take Lloyds for example. They've got about £150 worth of current assets. They got 150 billion in current assets, 100 billion in current liabilities. So you divide 150 by 100, you get 1.5. This suggests that Lloyds is in a strong position to cover its short-term obligations with the available assets. Okay, remember anything above 1 indicates financial health, operational efficiency, and the company has more than enough resources to pay off its debts which are due within 1 year. Okay, and the second company would be RBS, and now RBS has 80 million in current assets and 120 million in liabilities. If you were to divide 80 by 120, you get 0.67. Now, this could be somewhat of a warning sign of liquidity problems, as a company may struggle to meet short-term debts. Okay, anything below 1, you know, the company may have to rely on some form of external financing, may have to sell off assets, or face financial strain to cover these sort of liabilities. So if you had to pick out of the two, you would naturally pick Lloyd's. Okay, but with everything, I always say one ratio is not everything. We would have to take into account the bigger picture. But if we had to pick out of these two, it will definitely be Lloyd's at this moment in time. And this is how I suggest you build your own paper portfolios. Bring up a spreadsheet, put all the companies down, put all the ratios down, and that can help you make an educated decision. Of course, you got to look at the financial climate within the 6 to 12 months, because if we are going to be coming into some form of headwinds, we may want to position our portfolios maybe slightly different, maybe go more defensive if need be. Okay, but this is current ratios in a nutshell. Solvency ratios are financial metrics used to assess a company's long-term financial health and its ability to meet its long-term debt obligations. Okay, you will notice with this set of ratios is different from our previous ones where we were talking about short-term debt obligations and just current assets alone. Now these ratios are focused on providing more of an insight into the company's long-term financial stability, understand what sort of leverage they are using, and their ability to generate sustainable profits in order to cover these debt obligations for an extended period of time. Okay, so unlike others, we are typically comparing a company's long-term debt or any form of long-term financial commitments to the long-term assets, or what we will class as non-current assets. Okay, so a lot of the figures that we will be looking at will be reliant from what we see in the balance sheet, and there will be some ratios that will require figures from the cash flow statement. Okay, so when it comes to why we need to look into solvency ratios, one is for us as investors to understand the long-term financial stability. Okay, whether a company has the financial strength to meet long-term debt obligations. Okay, that could be interest payments, that could be loan repayments. So a company with a strong solvency, base or strong solvency ratio is better positioned to survive in the long term and ride any form of tidal waves that we could potentially expect down the line. Okay, risk assessment for investors and lenders. So it's not only us as investors that look at these ratios, it's also big lenders. Okay, it's vital for creditors and investors to evaluate the risk level of a company. Any company with high levels of debt, can signal financial risk, particularly if the company struggles to generate enough income to cover interest payments. That's going to show enough red flags for us to maybe not want to invest, and for lenders to say, what, we're going to have a step back. Okay, and that can have a massive impact on the overall capital structure of a company. Okay, companies with high levels of debt are more vulnerable to changes in interest rates. And if we do experience any form of economic downturn, this can lead to financial distress and companies going into liquidation because they are not able to meet their long-term debt obligations. Okay, so that just shows us, does it have that long-term viability? Okay, can it survive and grow in difficult times? Okay, if you are expecting the economy to change over the next 12 months and you're looking to invest in a company which has very high or have very dangerously high debt levels and they are struggling to keep up with payments, will it be a company worth investing for in the long term? The answer is probably no. So it's something that you may want to look into, as it can affect a lot of your decision making. Company with good solvency, though, is less restricted by its debt obligations, and actually has more room to grow. So you would ideally want to be looking at these sort of companies. As with anything, it's important to take a look at the industry peers. Okay, it's important to see how well the company you're looking to invest in is doing compared to other companies within the same sector or other companies which are in the same sort of arena. One other way of looking at the ratios is to really identify companies that are not necessarily in distress now, but can face further distress. Okay, it does act as a good early warning sign for any form of financial trouble. So any form of deterioration in solvency ratios could indicate that the company is becoming, over leveraged. Has a huge amount of debt, is struggling to manage its debt, or the risk of default on its obligations is very much evident. So, early indications of these issues can allow you to whether to get involved or not, but also allow management to take corrective actions if needed. Now, the ratios that individuals can look at, and as mentioned throughout all of my slides, is you can do your own research, or the information is already calculated for you out there. Interest cover is probably the most used solvency ratio, as this is the main one that measures the number of times a company's earnings can cover any form of interest expenses. So if you are doing this ratio, a higher interest cover is preferable. It means that the company is in a better position to meet its interest obligations and reducing the risk of default. So anything in excess of 1 is going to be perfect. The second one you may want to look at is debt to equity ratio. This ratio compares the total debt, to its shareholders. Okay, this in essence just shows how much of the company is financed through debt versus its own funds. A lower debt to equity ratio indicates that the company is less reliant on borrowing, and in that sense has a healthier balance sheet, or at least has a healthier balance between debt and equity. Okay, but again, industry on industry, it does vary. There are companies out there which are highly leveraged, got a huge amount of debt, but still remain incredibly profitable. You just got to understand what sector you're looking to get into. But ideally, you would want there to be a strong balance of debt and equity. The last thing you need is, a company overly leveraged, and we come into financial uncertainty, economic uncertainty, and this company will not necessarily collapse, or it just may not work as well. It may not be the best investment in the middle to long term. And finally, you got debt to asset ratio. This ratio shows what portion of a company's total assets are financed by debt. Okay, so it's purely a measure on a company's overall leverage. A lower debt to asset ratio indicates that a smaller portion of the company's assets is financed through borrowing, suggesting lower financial risk, which is great, especially if you are a startup. The less thing you need is over reliance on loans and debt. But again, it does vary industry on industry. Always keep that balanced approach. But in a nutshell, that is solvency ratios for you. Okay, when it comes to interest cover, it's used really to assess a company's ability to cover its interest expenses with its operating income. Okay, it's designed to provide an insight into the company's ability to meet its interest obligations on its overall debt. So in other words, we can determine the number of times that a company's profits can be used to pay its interest charges on its debt. Okay, so when we look at the equation overall, interest cover is EBIT, divided by interest cover, also known as operating income. So operating income is EBIT. Okay, earnings before interest and tax. Okay, that's what EBIT stands for. So it can be found on the income statement. It represents the company's earnings before any interest and expenses. So some P&Ls will have EBIT, most will have it phrased as operating income. Okay, operating income in essence is just calculated by subtracting all the operating expenses from the gross profit. Okay, if you have watched our previous videos, we've gone into detail. So it just represents the profit or the loss generated from the company's normal business operations before taking into account any form of interest and taxes. Okay, and then that is divided by interest expense. Now, again, this can be found in the income statement. It is typically listed under operating expenses, or it can be seen as a separate standalone line towards the bottom. It's in essence, it's just a cost the company pays for borrowing money. Okay, and that's through loans and bonds. How much does it cost in order for them to borrow that? Okay, so that is your equation, and we'll come on to an example in a bit. But why would, or I think it's probably best now to really understand what is classed as a good or a bad interest cover. Okay, high interest cover in essence shows us strength and stability. Okay, it indicates that the company is generating significant operating income relative to its expenses. This suggests financial stability and strength. The company is very comfortable, it has a comfortable margin of safety to cover its interest payments, which is important. It does highlight that it's credit worthy. Lenders and investors generally view a high interest cover very favorably because it indicates very low risk of default and very low debt obligations, to be fair. Okay, so a strong interest cover may lead to lower borrowing costs for the company as lenders perceive it as less risky. Okay, if you are more of a risky company, lenders will be happy to borrow you money, but they will charge you extra interest on that. But if they know that you're a safe company, they're happy to lend you the same sort of money, and you don't have to pay as high interest as a company which is riddled in debt. Okay, now when it comes to a low interest cover, it does signal potential financial distress. Okay, suggests that the company may be struggling to generate enough operating income in order to cover its interest expenses. This could indicate that the company is in distress or an inability to manage debt effectively. It could be elements with the board that we may want to look into. There is always that risk of default. Again, not always the case. It's not always black and white, but you do want to look at other factors that would contribute towards overall liquidity. But companies with low interest cover, may face higher borrowing costs, as we've already seen, or difficulty assessing or accessing credit. I'm sure anyone that's watching this video may be aware that credit cards, for example, will not issue uh, extended credit if you are unable to pay back your payments, or if you're struggling to make your phone bill payments or other credit card payments, you're less likely to be getting any form of credit. It works very similarly with business as well. So lenders will view them as a riskier option, due to the increased likelihood of them defaulting on payments moving forward. Okay, and for an investor, you're going to naturally be cautious about investing in companies with low interest cover. There is that heightened risk, there is that instability, so you may want to look at other companies within the same sector or operating within the same sort of field, as they may be a more suitable option for you in the medium to long term. Okay, now we're going to go into a very quick example of interest cover. Again, with the equation, it's EBIT divided by interest expenses. As we've seen, you can find this on the income statement, so it's not too difficult to find. So again, these are made up figures. So if we look at the operating expense or operating income, that is £500,000. And the interest expenses is £100,000. If you were to divide the two, you would have an interest cover of 5. So in this example, the company generates 5 times more operating income than the amount needed to cover the interest payments. Okay, it does show that the company is incredibly healthy. It's got a significant cushion to meet any form of interest obligation. Lenders and investors may view this very favorably, considering a sign of financial stability and lower risk. Okay, but do keep in mind that the interpretation of interest cover may vary depending on industry, company size, and other financial factors. However, in general, any indicator above one um, indicates that the company is generating enough income to cover its interest expenses, while ratios, whilst higher ratios do suggest that the company has a stronger financial position. So, all in all, anything above one will be great. Just because you have an interest cover of over five, it just may mean that the company is not reliant on debt. Okay, but again, it's a double-edged sword. In order to grow, a lot of companies do take on a huge amount of debt in order to finance expansion, and it could be acquisition of a new company. So you've got to look into the company in a lot more detail. Just because it's got a interest cover of five and it's very healthy, it may not also be associated with accelerated growth. Okay, so always look into it, but ideally it's got to be over one. In any case, anything less than one, the company is just struggling. Okay, investor ratios, also known as investment ratios or market ratios, are designed to help investors assess the value, the profitability, and the overall performance of a company. These ratios give you a good understanding and insight into a company's stock price, dividends, earning potential, and overall returns. So they are crucial for investors that are looking to make a decision about whether they're going to be buying, holding, or selling a company's stock. So there's a number of reasons why we want to pay close attention, especially if we're looking to bring on board investors or we are looking to invest ourselves. We got to really understand the value. Okay, so these ratios will help us really determine whether a stock is fairly priced or if it's overpriced or at times undervalued. Okay, and the P ratio would be one of the key indicators for that, which we will look at in a second. Okay, it will compare it to the industry average and can help investors really assess whether they're looking to purchase something that's undervalued, where there's further upside, or if something is overvalued, maybe the upside is very limited. So is it worth the risk? These are factors you would want to look at. The big one for us would also be profitability. Ratios like earnings per share, will give us a good insight into how profitable a company is and whether it is generating adequate returns for shareholders' investments. Okay. If you are a dividend investor, for example, you want to be looking at dividend yields, dividend covers, as they're important for anyone that's maybe near retirement or focusing on retirement planning. Okay, these indicators show how much cash flow investors can expect by way of holding those shares. Um, Growth is going to be a big impact. Obviously, looking at earnings per share once again, P ratios. We want to understand what the future growth potential is. We can understand trends. If we look year after year, go onto Yahoo Finance, go onto Hargreaves Lansdown, go onto all these websites, look at all the previous years. Has earnings per share been increasing time after time? Are you seeing a good return on your investment? Is the company overall growing? Okay. Um, so these are a lot of the key uh, factors that we look for in order to make an informed decision. You know, you're better positioned once you've got all the information in front of you, and that will allow you to understand if you're looking to buy or sell individual companies. Now, there are a number of ratios that you can look at, and we will go through most of these. Earnings per share. When we talk about earnings per share, it's simply a way to measure how much profit a company makes for each share of stock that is currently outstanding. So it tells investors how much money the company earns for every share that they own. Okay, so how profitable is a company? So earnings per share helps investors really compare profitability between companies. A higher earnings per share generally means the company is more profitable, and it could indicate better financial health, making it a more attractive investment for individuals. A very quick example will be like if, for example, a company has made £1 million in profit, okay, and it has 1 million shares currently issued. If you were to divide the two, the earnings per share would be one, okay, which means that it's earning £1 of profit per share it's got currently outstanding. And naturally, the higher the number, always the better. The next one we will look at is the PE ratio, the price to earnings ratio. It just helps investors determine whether a stock is fairly priced, or is it overpriced, or is it undervalued. It's all based on its earnings. Okay, so a PE ratio compares the company's current stock price to the earnings per share. Okay, it tells us how much an investor is willing to pay for each pound of a company's earnings. Okay, so if, for example, a stock is trading at £50 and the company has an earnings per share of £5, the P ratio, would be 10. What that would mean is investors are willing to pay £10 for every pound of a company's earnings. So a higher P ratio means that the stock might be overvalued. Okay, it could continue to propel, but you can look at it from the flip side. It could mean that the company's future expectations may be not that accelerated. Or a company could have a low P ratio, which suggests that the stock might be undervalued. Okay, it could either be facing challenges and it's not that desirable, or you could see potential, or the potential hasn't been realized. So you're picking something up which is undervalued, so the upside could be quite considerable. Okay, so investors use P ratios to compare within the same sector to see which stock might be a better value or has more growth potential. Okay, the next one would be dividend yield. Um, in essence, an annual dividend payout by a company is relative to its stock price. Okay, a dividend yield is important for us to really understand how much out of the profits a company will be distributing towards their investors. A higher dividend yield, the better. It means that we're getting, more back for our investment. Remember, a lot of growth companies tend to have a very low dividend yield. They tend to reinvest their profits into growth, but value companies tend to distribute their profits to their shareholders, which make it a lot easier, especially if you're focusing on retirement planning. And finally, dividend cover. It shows how many times a company's earnings can cover its dividend payments. Okay, so in essence, it tells investors if a company is making enough profit to pay its dividends to its shareholders. That's all it tells us. Okay, the more, the higher the dividend cover means, the more times we can cover the dividend payment, which makes it more desirable. If the ideal, and we will come on to it if we look at the later slides, um, a dividend cover of 1.5 is ideal. It means you can cover that dividend payment 1.5 times over. Anything less than one suggests that the company does not have enough earnings to distribute that dividend, which could make it very challenging. So in a nutshell, that is the investor ratios. Like I said, it's important to compare against companies within the same sector, and all this information is readily available on the likes of Yahoo Finance, Google Finance. It can be on Hargreaves Lansdown and other publications out there. Earnings per share is, arguably the single most important ratio out there. Okay, it's important for investors because it gives them an idea of how profitable a company is in relation to the shares it's got outstanding. So a simple way to look at it is how much profit is a company generating for each share that it has. Okay, and we say shares outstanding, what shares are currently available for public ownership. Okay, a higher earnings per share generally indicates that the company is more profitable, which can be a positive sign for investors, especially if it's year on year on year. Earnings per share keeps getting stronger. Earnings per share is listed right at the bottom of an income statement. Some income statements have it, some don't. Okay, the equation is net income, take away dividends of preferred stock, divided by the number of common shares outstanding. Okay, now this figure can be adjusted based on the fact that sometimes companies do not have preferred stock. So then the figure will simply be net income take away um, average number of shares outstanding. Okay, so um, yeah, so when we talk about net income represents the total profit a company has. You know, the total profits is earned during a certain period of time, and that is usually over the course of a year when you see these things reported. This is after deducting all expenses, taxes, any interest payments. So the net income is always at the bottom of the income statement. It is classed as the bottom line. When we talk about preferred dividends, we're not talking about ordinary dividends. These are all related to preference shares or preferred stock. So if a company has issued preferred shares, it may pay dividends to these shareholders. So preferred dividends are subtracted from net income to arrive at the earnings available to the common shareholders. It is typically disclosed in the footnotes of usually the income statement. You will naturally tend to find it. And then whenever we talk about the average outstanding shares, this is the average number of shares of current stock outstanding during that period of time. So over the course of the year, how many shares were actively available for ownership. So this information can be found in the balance sheet under the shareholders fund section. Okay, so do keep a close eye out on that. So when we talk about, what's classed as a good figure, we always say high earnings per share. It typically indicates that a company is generating significant profits per share it currently has. So it's being managed well, it's managing its resources and operations well. In turn, that's generating solid earnings. Okay, so consistently high earnings per share will signal to investors that the company is financially healthy, it's got strong potential for growth, um, and it can suggest that there's going to be good return over a prolonged period of time. Okay, the way the markets perceive it is, it will naturally attract a lot of positive attention from investors and analysts. It can lead to increased demand, which in turn is going to lead to its share price going up. So whenever you see articles out there of, top companies to buy, top stocks to hold, earnings per share figure will always be there. Again, the article may allude to year after year, they are seeing solid amount of earnings, and that will give investors a good indication to say, you know what, we'll continue to buy it. Hopefully, there's no serious headwinds in the future. If we are seeing some economic downturns, you may then want to look at some of the liquidity and solvency ratios just to make sure that the company is managing its short-term and long-term debt obligations a lot better. And so then, you're making a lot more of an informed decision. If a company has a low earnings per share, it will naturally signal a lot of concern. It could suggest that the company is struggling to generate significant profits relative to the shares it currently has outstanding. So this could raise issues about its financial health and its ability to sustain operations. Um, as an investor, you know, it, it can suggest, lower profitability. There are going to be challenges going forward, but I would always look at it from two standpoints. Fine, earnings per share may be low, but you want to see what it's done year after year. During the previous years, has it, reduced its debt levels? Has earnings been per share been getting better and better over time? If that is the case, it could be an undervalued company, so there may be some, growth. It could, turn the tables, and it could see some accelerated growth. So I wouldn't naturally dismiss companies with low earnings per share. I would also look at their debt levels. I would also look at um, their previous years on, what's changed. It could be the fact that they've had debt restructuring programs in place, and so they're recovering still very well. They might have been hit by challenging economic climate. They could be in a sector which is adversely hit. So we've got to take into account all these factors. Don't always take everything as black and white. There are limitations with earnings per share, because remember, the earnings per share figure is taking into account net income, which is absolutely fine, but it's always the number of shares outstanding. So earnings per share can be manipulated. you know, companies can very easily do share splits. They could do stock buybacks, and that could reduce the number of shares in the market. So if you were to, you know, do the equation again, you can manipulate the whole earnings per share figure. So it's important to understand, you know, the number of shares being issued every year and so forth. Is it consistent? Is it not? So these are the factors you would want to look at when looking into earnings per share. Okay, we now have an example of earnings per share. Let's remind ourselves of the equation. Earnings per share is net income, which you find on the income statement right at the bottom. Take away dividends of preferred stock. You can sometimes find that figure in the income statement, or it could be within a footnote. Divide that by the average number of shares outstanding, and that figure you can find in shareholder funds. Okay, that is the figure of that is the formula for earnings per share. But just to remind you, if a company does not have preference shares or preferred stock, or any form of distribution, you don't have to include that in the equation. So it will then just be net income divided by the average number of shares currently in the market, or not currently, based on the year that they're looking into. Okay, so with our example here, the company has earned a total profit of £1 million. However, £50,000 of that profit was used to pay dividends to preference shareholders, leaving it with £950,000 available for common shareholders like yourself. Okay, since there are 500 shares of stock outstanding, you would take that 950 divided by the number of shares currently in the market. So for each share that you own as a shareholder, the company has made approximately £1.90 in profit. Okay, this gives you an idea of how profitable the company is on a per share basis. Okay, higher the number, always better. Lower the number, obviously not great. But you can't just base it on what you see here. It's important to compare earnings per share with other companies within the same sector. Okay, that will then give you an understanding of if this company is actually better than the next company. But that is a very simple example of earnings per share. Okay, P ratios, or price to earnings ratio, is again a very prominent and important ratio out there. Works very well with earnings per share as well as dividend cover. It's a very important profitability ratio. You will see on a lot of publications, websites, so I'm sure it's very common to you. But it's important that we break down what it means and how it could add value to our decision making. Okay, so investors use P ratios to evaluate whether a stock is relatively cheap or expensive compared to its overall earnings. So in a simple way of looking at it, it's a gauge on how much investors are willing to pay for each pound of a company's earnings. Okay, are you prepared to pay over and above, and how much are you prepared to pay over and above for that stock? Okay, so P ratio compares the current price of the stock, that's how much you have to pay for one share, and then you would divide that by the earnings per share, which we've seen, or if you haven't seen, visit our previous slides. Okay, and now we want to look at what is the significance of this formula. Why is P ratio so important? One is it's a very strong valuation tool. It's a quick way really to assess whether the stock is overvalued or undervalued relative to its earnings. And there's two schools of thought here. Certain sectors will naturally have very high P ratios, okay, especially a lot of growth stocks. That tends to be an area where they have high P ratio. They've got accelerated growth, so people are prepared to pay a huge amount for per pound of earnings, in essence, that the company makes. But the flip side of that, if something is overvalued, the upside may not be unlimited. Okay, it may not have a huge amount of upside left. It's more than likely to see some form of a pullback, not necessarily a collapse, but may see some form of stagnated growth. Okay, so you may not want to invest too heavily into this sort of area, especially if the economy is set to have a pullback. And on the flip side of that, if a P ratio indicates that a company is undervalued, it seems to have less appetite. Investors may not be looking to invest heavily in this stock for one reason or another. Okay, it could be based on the fact it's had a hard time, it's been affected massively by inflation, or it's just in a very difficult sector. The other way of looking at it is by weighing up all the other ratios, looking at the other financials, and it could actually be a value stock. It could be a stock that comes back to life, so in essence, you're picking it up cheap. So by doing so, the upside would be, that bit greater. So it's important to really weigh it up. Growth stocks naturally have very high P ratios. Value stocks have consistently lower P ratios, not necessarily low. Um, um, Often investors will use P ratios to compare companies within the same industry, which is vital. Like I always say, there's no point me looking at United Utilities and National Grid and comparing that with Anglo American, Barclays, or Antofagasta. It makes no sense. They're in completely different arenas. Okay, so whenever we look at that, always compare it to sectors and industries that they are all in. They have to be the same. Okay, so I've mentioned growth and value. So growth stocks will typically have higher P ratios due to the potential of future earnings growth. Value stocks tend to have lower P ratios, indicating that they are undervalued relative to their earnings. Now, when it comes to market sentiment, changes in P ratio can really can indicate big shifts in market sentiment. A rising P ratio might suggest increased investor confidence, while a declining P ratio could signal fear. So important to understand the trend, see how well it's going year after year. Now, when we talk about high and low earnings per share, what is classed as good, what is not classed as good? Remember, it's all based on industry, but the way you want to look at it is by comparing it with stocks within the same sector. It will help you determine a stock's overall market value compared to its earnings. So, the P ratio really just tells you what the market is willing to pay today for the stock based on its past or future earnings. Okay. High P ratio, as we know, can signal a lot of strength. A low P ratio can indicate that the price is relatively low to its earnings and could be undervalued. Okay, now we've got an example of P ratios. We've got company X and company Y. Let's assume that they are both within the same sector. Okay, and let's become familiar once again with the equation. So P ratio is equal to the market price of the share. Divide that by the earnings per share. Remember, earnings per share can be found on your income statement. Okay, so company X has a market price of £60 per share, and it had an earnings per share over the last 12 months of £6. So they've got a P ratio of 10. Company Y has a current market price of £75 per share, but has an earnings per share of 8, which gives it a P ratio of 9.3. Now, I'll be brutally honest with you, obviously higher is naturally seen as that bit more desirable, but they are very close within their P ratio, literally 0.7. Many could argue company X would be the one to go for, but ideally company Y would be the more attractive, even though the share price is higher. Company 1 is more profitable, and even though having a smaller P ratio, the earnings per share is that bit more attractive. So we wouldn't go as far as saying it's undervalued, but we would look at both, and both of them have very relatively similar P ratios. So then we would also backtrack and see what their earnings per share is like. And company Y would be that bit more attractive. It is delivering more profit, per share it's currently got outstanding. So company Y would be our choice. If there was a big gulf in the figures, let's say for example company X was at 10, company Y was at around about 6, 7, you would then definitely go for company X. But when they are very closely aligned, remember always to backtrack, look at what the earnings per share is saying, because the EPS is the single most important figure out there. it does gauge profitability. It does take into account a lot of information that we are seeing on the income statement. So yeah, again, it can be open to interpretation, but the way we would look at it is company-wide would be the choice based on the fact that PE ratios are both very similar, but company-wide has a stronger earnings per share. Okay, dividend cover. Dividend cover, in essence, measures a company's ability to pay dividends to its shareholders out of its total earnings. Okay, indicates how many times a company's earnings can cover its dividend payments. Okay, it's important to note that this interpretation of dividend cover can vary by industry and company. Some industries traditionally have higher or lower dividend cover ratios due to specific characteristics and capital requirements. A good example, a lot of growth companies will have very high dividend covers due to the fact they give little to no dividend. Okay, so they're able to cover that dividend many times over. But strong value companies, which offer very attractive dividends, their dividend cover is in the region of the 1.5, because they are distributing so much of their profits, they can only cover it one time over. Okay, because they are distributing quite a lot. So the more attractive companies will offer you lower dividend covers. Companies that have very high dividend covers means that they're not necessarily issuing the biggest amount of dividend you can have out there. Okay, so when we talk about the importance of dividend cover, it really helps with our decision making. It's essentially crucial for income-focused investors, such as anyone approaching retirement, already retired, who really rely on dividend payments for income. Okay, so a strong dividend cover does provide that assurance that the dividends are sustainable and predictable. Okay, a risk assessment, by examining the dividend cover, investors can really gauge the risk associated with a company's dividend policy. A high dividend cover generally indicates lower risk because it's distributing virtually nothing. Okay, while a low cover does suggest potential challenges ahead. This is especially for dividend covers of less than one, because that does suggest that the company does not have enough earnings to cover the dividend that they've already quoted. One thing you will always know as well is companies will come out with a dividend yield that they expect to give, but they do revise that figure a lot of the time. So it's very unlikely you're going to see companies with dividend yields of about 10%, 12%, because it's highly unlikely they're going to be able to have enough earnings to really cover that. Okay, and as well, it gives us a good understanding of financial health. It's a reflection of the overall health and profitability of a company. So consistently high dividend cover ratios can indicate a well-managed company. Okay, but in our opinion, as anything over 1.5, they tend to be the strongest dividend payers. Okay, especially if you're looking for income, that's the way you want to go about it. The comparison tool is important. You can type into Google the top 5 dividend companies or a top 5 dividend paying FTSE 100 companies. They'll come up with a list. It's always essential to go into each company and really see what their dividend cover is. How often have they paid dividends every year? Okay, you can easily backtrack, see how well they covered their dividend in the previous year. That will give you an understanding on how sustainable the dividend is. Okay, so you've heard me talk about dividend cover of 1, 2, and so forth. So when we talk about a dividend cover greater than 1, okay, this suggests that the company is generating sufficient earnings to comfortably cover its dividend payments. Okay, this is generally a positive sign for investors, indicating strong stability and a low chance of dividend cuts. Whilst a low dividend cover of less than 1, such as 0.5, 0.7, means that the company is paying out more in dividends than it actually earns, and it's highly unlikely that always occurs. So this raises concern about the sustainability of the dividend. Is it just maybe going to be a one-off, as a company may need to reduce or eliminate dividend payments at some stage if their earnings do not improve? They'll have to just stop giving it. A dividend cover of just about 1 indicates that the company's earnings are just enough to cover its dividends. Whilst it shows that the company can pay the dividends, it offers very little room for growth. If earnings do decline, we could see pressure on dividend cuts. But in my experience, I see the likes of National Grid, United Utilities, they always tend to be good dividend payers. Glaxo, AstraZeneca, they tend to sometimes have dividend covers of 1.1, 1.5, but they always pay their dividends. So take everything with a pinch of salt, but everything above 1 is important, and it does indicate good health. Remember, a lot of value companies, they tend to distribute a lot of their profits anyway. They don't tend to use a huge chunk to reinvest in growth. So yeah, that's dividend cover in a nutshell. Okay, now we've got an example of dividend cover here. Okay, we've got company XYZ. Its net earnings or net income was £10 million for the fiscal year, and it will be paying out £5 million in dividends to its shareholders during that period of time. Now, when it comes to the formula, there's many different ways of going about it. Earnings per share divided by dividends per share is one way, but we'll focus on the alternate version, which is the net income divided by dividend declared. If we were to do that, 10 million divided by 5 million would leave us with 2. Okay, so we would have a dividend cover of 2. So a dividend cover of 2 means that the company earnings are twice the amount of the dividend payments, which is great. The company is comfortably able to cover its dividend obligations. It does suggest that the company is facing very little risk, and is able to sustain its dividend payments, which is brilliant. Okay, and that's the way we would tend to look at it. Of course, you can do the ratios differently. You can do it via the earnings per share way, or you can just do it via the net income way. You will still come up with the same sort of figure. Okay, so remember, anything above 1, brilliant. Anything less than 1, the company doesn't have enough earnings to make the payments of the dividend, so it will unlikely do so. Okay, anything near 3, 4, 5, absolutely fine, but expect a lower dividend yield when you see a cover of that nature being that high. Okay, now we're going to look at some of the pros and the cons associated with ratio analysis. So we'll focus very much on the positive. There are several advantages when looking at ratios. One being assessing financial health. Okay, it does provide us with a great snapshot of a company's financial condition. It enables quick assessment of liquidity, profitability, and how solvent a company is. Okay, so that's one of the main elements. Forecasting, identifying trends, looking at past data, year-on-year data can help us predict future performances and really gauge the overall financial health of the company. So that allows for a lot more strategic planning. Okay, competition analysis is something that I discuss quite heavily in all of my slides. It's irrelevant to a degree having all this information in front of us without comparing it against its peers. Okay, so we can identify a lot of the strengths and the weaknesses when we do compare it with others. And the next one, which is very important, is highlighting problems. Okay, significant deviations from previous years is important to look at. Year after year, if things are improving or getting worse, it can highlight areas of concern, which could prompt deeper investigation into what the underlying issues may be. So the ratios can help make us aware of any form of financial distress or any operational inefficiencies that really need addressing. Okay, whether that be revenue on the decline, whether that be our short-term debt on the incline, not being able to accommodate with the current assets we have, long-term debt spiraling out of control. These are factors that are easily readable and able for us to go into the last part, which is our decision making. Okay, it makes life a lot easier to make educated decisions. Of course, everything is not bulletproof, but it does help us set our priorities, allocate resources where we need to, and into the right areas. And the final point that I would like to mention, which is not really on this slide, but is the simplicity and the clarity of ratios. Don't forget it condenses a lot of the complex financial data into a lot more easily readable figures, and it makes it easily accessible for us. I think that's one of the key parts. So the quick calculations and the insight will allow us to go make our decisions a lot faster rather than having to dig through all the information bit by bit. Okay, so into our next section, while ratio analysis is valuable, it is an essential tool when you are making investment decisions, there are certain limitations that we have to be aware of. Okay, one being the fact, and probably the most obvious, this is historical data we are looking at. Ratios are based on the previous 12 months or the previous fiscal year. So it may not accurately reflect the current market conditions or future performance. Okay, within that time frame, you can have economic shifts, you can have change in regulations, there can be significant geopolitical events that can render any form of historical data or ratios less relevant in today's market. Okay, sector differences. The ratios do react differently to different sectors, so it can make it that bit more difficult to read. But as I always say, always focus on comparing companies within the same sector. Okay, as some sectors, prefer high PE ratios, whilst others don't. Okay, and the final one would be manipulation. Companies can engage in practices, that can make their ratios that bit more favorable. So really obscuring their true financial health. So management can choose specific ratios to highlight strength whilst downplaying a lot of the weaknesses. And it can lead to some form of biased interpretations. And one other way of looking at it, which is contrary to, some of what I've mentioned, but you can have that element of oversimplification. It's a simplified view of financial performance, potentially overlooking a lot of the underlying complexities and then other forms of nuances within the business. So, um, you know, as with anything, take a balanced view of everything you will read. Try digging as much as you possibly can. The best investors out there are the ones that tend to buy and hold, and they tend to stick it out. Good growth, good dividend paying companies. That's what tends to work. But overall, ratio analysis is essential in making any form of investment decision for the medium to long term.